Aterian stock has been trending in popularity recently, and many people are wondering if they should buy more, sell what they have, or stand on the side and wait for a better timing. As the market is still very volatile at the moment, we should always be careful about which stocks to pick and what should be the exposure and timing of the positions we take. The price action of Aterian has brought the stock to $4.78 before stabilizing around $4.20. The short-term price trend of Aterian is obviously bullish. The market has clearly shown a sudden spike of interest to keep the hope up for a short squeeze, and the recent price action shows at least a desire to break from the bearish trend that we've been having over the past few weeks, and I will say even month. When we look at the long-term price trend of Aterian, it has been ranging, surprisingly enough, with a very significant spike in early 2021, giving shareholders the hope that this may happen again. And I think that given the amount of short interest that is still significant in the volume, this will remain as a clear signal for many retail traders that this can boost the stock price if those short positions are forced to be redeemed. Now, let's take a look at the technicals of the stock. The trading volume of Aterian has recently been 86 million shares versus the average volume of 20 million shares. Over the previous 52-week period, the price fluctuated between $2.10 and $30.65. The market cap of Aterian is currently at $290 million versus the enterprise value of $208 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets when the debts are paid off. If the company has a lot of debts or a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many companies as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company can generate more profit or grow faster than its rivals, partially because it's assumed that they have a better management team, a stronger brand recognition, and a bigger online following. It is basically what makes it unique compared to an alternative competitor. In other words, it's not a tangible asset that companies may use. However, it's often the reason why some companies are perceived to be trading at a discount, as the market cap is lower than the enterprise value, since the enterprise value is also less reactive than the market cap in very volatile situations. If the company goes to liquidation, there won't be any goodwill, and we would be left to distribute whatever that is left and that is not impaired on the balance sheet, which is far less than the current balance. When we compare the current price to the historical price fluctuations, the stock is 101% higher than the 1-month low, 101% higher than the 3-month low, and 101% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 213%. Versus a historical volatility of 165%. The put-call volume ratio is currently at 0.15. It's normal for many stocks to also tend to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 37,000 contracts a day, versus the 30-day average of 30,000. In terms of open interest, the most recent volume of open interest is 161,000 contracts versus the 30-day average of 70,000 contracts. In terms of its shareholder structure, institutional shareholders own about 18% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. It's relevant to understand the shareholder composition of a company, as this helps to determine if you should hold the stock long term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can be potentially a sign that the stock lacks the depth to justify long-term holding. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions, since many great titles are also mostly held by retail traders, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there are significant short interest in the total volume, and this could be a sign that there's an organized shorting operation going on, like what happened with GameStop and AMC. The current short interest is 18% of the total floats, and 65% of the transactions come out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of it comes out of the dark pool, this suggests that there are institutional positions taken to short the stock, and there would be potentials for a short squeeze. My recommendation for Aterian, given all these considerations, is to buy a small position, or at least make sure that you have some existing exposure in it, and to keep some room to buy later as well. The stock is relatively high at the moment, and if we look at the big picture, it's still overall reasonable. So with such a spike recently, we should expect the stock to retrace or pull back somewhat within the next couple of days. My recommendation for exposure is between 1 to 3% of your portfolio. I would also recommend to split the allocation in batches of 20% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.